I admit that I love the basics, and in this video we'll look at the first 3 learning outcomes that are associated with the time value of money. What could be more basic to finance than the time value of money? So we'll look at specifically how we might interpret an interest rate, and we have 3 different ways to interpret an interest rate. Second, we'll break down the interest rate into its pieces. It's the sum of a real risk-free rate plus a premium for inflation, plus additional premiums for default, liquidity, and maturity. Third, we'll calculate the effective annual rate, and in doing so, we'll make a distinction here, an important distinction between the effective annual rate and the stated interest rate, also called the nominal interest rate. The first learning outcome here is almost philosophical. It asks us to interpret an interest rate in one of 3 different ways. And it might be true that we can interpret it in 2 or all 3 of these ways simultaneously. So this is our first step here into a key theme, I think, in finance with respect to interest rates, which after all are fundamental building blocks in finance. And that key theme is that although in life sometimes a rose is just a rose, an interest rate is not just an interest rate in finance. What I mean by that is if I said to you that the interest rate is 8%, we'll soon learn in finance that I have not been specific enough. It's imprecise. You don't have enough information yet to use this in a calculation. In at least 2 dimensions so far here. First of all, the interest rate, this phrase, and when we shift over from and look at financial risk, we can call this the interest rate factor. Either of those terms, interest rate or interest rate factor, are umbrella terms. There are specific types of interest rates under those umbrella. We need to specify which one. I'll just give you 4 among several. This could mean the spot rate, also called the zero rate. It could be the forward interest rate. It could be a par rate, also called a par yield. And it could be the yield, which stands for yield to maturity. Secondly, in terms of the second dimension that we haven't included here, you might have noticed I didn't include the time dimension or time horizon. Is this an interest rate over 1 year? Is it per annum? Or is it maybe over 6 months? Is it semi-annual, so to speak? So I need to be more specific about what the interest rate is before I think we can talk about how to interpret it. These interpretations can be, here you can see either it's a rate of return, a discount rate, and or an opportunity cost. So in terms of the rate of return or required rate of return, this would be from the investor or shareholder perspective. It's common to see this in project finance, where as a consultant, I oftentimes saw it most commonly, I think, in terms of this phrase, hurdle rate. So you can imagine yourself as the investor. I've invited you to invest in a project, and you may have a required rate of return. You may have already established that you don't invest in projects unless the expected rate of return exceeds your required rate of return. So it's greater than or equal to your required rate of return, that you have different ways to establish that. Maybe that's your cost of capital. And so maybe that's a function of the risk-free rate plus a number of premiums that you add as compensation for the risk that you're going to assume. So that's the first of the 3. The interest rate could simply be a required rate of return from the investor's perspective. The second is the discount rate. So this might be the most common way that we encounter it. And this is when the interest rate is used as a discount rate to translate a future value into a present value. If we think of ourselves standing here at time 0, and we either know or expect that we're going to receive $100, let's say in 1 year, it's very common for us to use an interest rate as the discount rate to translate that future value into the present value. The higher that discount rate, the lower that present value today. The lower that discount rate, the higher the present value today. And of course, or maybe not, of course, but if I told you that you have to wait 2 years to receive the $100 in the future, you probably would assign less present value to it today. Although in our own forum, just in the last 2 weeks, I had one of our smart customers remind me that that assumes that the interest rate is positive. If the interest rate is negative, you'd actually prefer to wait longer to receive it. I thought that was a good point. Here I have a common matrix used to translate here an input as a future value into various present value. Combinations of present value as a function of the horizon here in columns and the interest rate in rows, where the interest rate is a discount rate. And yes, here it's true, at least in terms of my display. I'm guilty of my own sin. I haven't indicated or been precise about what I'm using here. So I'll just speak to that. These are interest rates are, for example, 2% per annum with continuous compounding, or in this case, we could say with continuous discounting. I mean, continuous compound frequency. So I'm not going to worry about the details here, but that's just to show you how we would use the interest rate as a discount rate to say, for example, that if we're going to receive $100 in 10 years and our discount rate is 2%, that the present value is $81.87. So that if we work down the column here, and so we're staying on the 10 years. So in all three cases here, we're receiving the $100 in 10 years. But as we move down the column, we're increasing the interest rate, which in this context is increasing the discount rate. As we increase the discount rate, the present value drops. Now, on the other hand, if I start here at the 81.87 and then I stay on the row and go to the right, so now I'm going to stay at the 2% discount rate, but I'm going to go from 10 years to 20 years. In other words, I'm receiving the $100 in 20 years. You can see it has a dramatic effect on the present value. And if I go all the way out to 30 years, that present value is almost cut in half. It's quite dramatic. You would be waiting a long time, so it makes some sense. And no wonder the lottery likes to spread out or defer those payments to the winners out way into the future because it reduces the present value of the payout. So if you're interested in a real life context for this very important idea, my favorite would just be the Federal Reserve and how investors in the stock market watch the Federal Reserve really on a daily basis to see what they're doing, right? The Federal Reserve has a federal funds rate, which I believe is currently set at 2.5%. Investors watch this daily. They scrutinize every statement and hint as to what the Federal Reserve might do with this rate. Now, admittedly, it's an overnight interest rate, so it's a very short-term interest rate, and there's a whole term structure of interest rates. But we generally assume this is correlated with the short rates and or has a direct impact on the short rates and correlated with the longer rates. So there's a lot that goes into that and a lot of commentary and discussion about the dynamics, but start just with the first primary reason that matters to investors is that it's a discount rate, right? Investors out in the stock market, I'm going to use really silly numbers, but they may have a company with a future cash flow where they know that's, again, using my round silly number of 100, that's a future cash flow. The stock price for that company that's going to generate a future cash flow is largely based on discounting the future expectations. And so if the Federal Reserve's number here of 2.5% is correlated with the discount rates used, well, it has a direct effect on the present value and therefore the stock price of the company, right? Maybe at 2.5%, that present value of that company is, I'm just making this up, maybe it's $75. Well, investors generally don't like it when the Fed says we're going to raise that discount, we're going to raise that federal funds rate, and we're going to be increasing your discount rates because that's going to lower the present value of the future cash flows. And on the other hand, they very much like to see, right, a loose policy where the Federal Reserve is either lowering or even says they might, even hints that they might lower that rate because you're, first of all, before all the other factors and complexities, that means we're lowering the discount rate applied to future cash flows, the stock market being future forward-looking, and therefore has a tendency to increase the present value and therefore the stock price. So hopefully that's a useful real-life instance of that. The third of these three is opportunity cost. This is an easy one to gloss over, although I'll tell you, in beginning finance, we don't pay much attention to it. And then when we move to intermediate and advanced finance, opportunity cost gets baked in explicitly almost as a routine matter. So this is the road not taken. And the simple idea here is that if I ask you to invest your cash in my project, you're tying up cash in my project that you could have used somewhere else. At a minimum, you could put it in the bank in a deposit account, an interest-bearing account, and you could be making interest on that. At a minimum, right? You have other uses for that cash. The third of these is more subtle, and it's one that in beginning finance oftentimes gets skipped, but then when you get to intermediate and advanced finance, opportunity cost actually gets baked in almost routinely. And this is the road not taken, and it's just the idea that if you're the investor and you use your cash to invest in my project, that is an opportunity cost. You could have used that cash for something else. At a minimum, you could have deposited it in an interest-bearing account. So as soon as we get to beyond basic finance, we explicitly count the opportunity cost as a funding or financing cost. So an example of this would be in commodities. Here, my commodity picture has oil, corn, wheat. Those are consumption commodities. Also have gold. That's a consumption and investment commodity. Most companies need to buy commodities as inputs. And so one way to do that is just go to the spot market, buy the commodity today, and pay cash for it. Although there's opportunity to the cash. They buy the commodity that way, they can't use the cash for something else. So they could go to the futures market, where are there derivatives, including futures contracts, and they could, knowing that they need the commodity in a year, they could enter into a futures contract. There's a promise to purchase that commodity in the future at a predetermined price. And that way, they get to use their cash in the meantime for something else. Although when we go to determine the theoretical price of these futures contracts, we explicitly count the cost of financing on these contracts. They are basically priced in for opportunity cost because somebody has to incur the opportunity cost to borrow the cash to buy the commodity and store it in the meantime. Opportunity cost gets counted whether or not the investor has the cash. That is to say, if you're going to buy the commodity today and you don't have the cash, you would borrow it and incur a borrowing rate. So that would be explicit. But if you already have the cash, then you don't need to borrow. But we typically still count the opportunity cost of that cash that you already had because, again, you could have used it for something else. So that's the third reason it's subtle, but it's just as important as the others. So the next learning outcome asks us to explain the interest rate as the sum of the risk-free rate and premiums. So you can see we start as our base ingredient here is the real risk-free interest rate. And then we have, in this case, under the CFA syllabus, we have 4 premiums that are compensation for risk incurred. So this is really from let's say, a supply perspective, right? When we think about the interest rate from now an economics or macroeconomic perspective, we can look at it in terms of supply and demand, which is to say we can have the interest rate here on the y-axis, and we can have loanable funds on the x-axis, and then we could have a supply curve, which means that the higher the interest rate, the more interest there is in extending loans. And on the other hand, so I'll call that the supply curve, and then the demand curve would be downward sloping, which is to say that borrowers generally, the lower the interest rate, the more interested they are in borrowing. So this perspective over here, at least in my opinion, is from the supply side, which is to say, if you are going to lend money to me, what interest rate are you going to charge? Well, if you want to break it down here, you'd have a real risk-free interest rate plus a premium for inflation, and that is the compensation for the risk that there's going to be an erosion in your purchasing power over time as you wait for that money to be returned. Secondly, here, this is the credit risk component. You loan me money, there is some risk. It's not risk-free that I may default on that. You certainly need to be compensated for that. So that credit risk is the default risk premium. The liquidity premium is very important. Let's say it's a company issuing a bond, or for that matter, you loan me money by investing in my bond that I issue to you. Liquidity is very important, right? It means if an emergency comes up, you may need to convert your assets to cash quickly. If you can convert to cash quickly, then you have liquid assets. If it takes you a while, if it takes time for you to convert your assets like the bond to cash, you're not as liquid, you're illiquid. Or put another way, if you've got my bond and you need to convert to cash quickly and you need to do a fire sale, you need to take a discount on it, that's also not good liquidity, that's illiquidity. So the liquidity premium turns out to be very important because in general, investors want to be assured that they're compensated for any inability to, or any time that they're going to be forced to wait to convert their assets into cash. And then there's the maturity premium, right? Well, that's the term structure of interest rates. The idea that the longer you're waiting for the loan, the more inherent risk there is. Another way to look at this is that present value is more sensitive to changes in the interest rate the longer the duration here of that loan. So visually, the first two combine importantly. The risk-free rate plus inflation is the nominal interest rate, and that's oftentimes when we read the interest rate, oftentimes it's not really stated, right? If I say 8% interest rate, more often than not, it's a nominal rate, and we just haven't said that, such that we really specify when it's a real risk-free rate. And then the other three components could be added on top directly to the nominal risk-free rate. So then we have the calculate and interpret an effective annual rate given the stated annual interest rate and the frequency of compounding. So here is a real simple formula that converts our present value into the future value over n number of periods, right? So here R is our interest rate and n is the number of periods. In this example, $100 in present value is compounded at a rate of 13% over 20 periods. This could be 13% per annum, this could be 20 years, but it doesn't need to be. This is just per period. And we do want to be able to use the calculator for this, right? So for example, there are different ways to do this in the calculator. I've got my calculator set in terms of the order of operations. There's two settings, right? It's a toggle. It can be either algebraic operating system, AOS, which I do not have it set. I have it set to my default, which is the chain method. And so I like to work inside out, but that's just my preference. So if I'm doing this calculation here or just repeating it, I like to start inside this parentheses here and say my 13% rate, I add 1 equals, then I've got what's in my parentheses. I'm going to raise it to 20. So that equals this amount here. And then I'm going to multiply it by my present value, right, to get my future value. Then we have frequency of compounding. And so this is the general form. This generalizes on the previous expression. This now says the future value here is a multiple of the present value that's informed here by 1 plus the stated rate. So I would highlight that R sub S is the stated annual interest rate. I don't have stated written in here, but this is the stated rate divided by M. That is the number of compound periods per year. And so that what we have right there can be called the periodic interest rate. And then we raise that quantity to that same M multiplied by the number of years. So this is a general form where M could take different values. If we're doing annual compound periods, that's 1 period per year, M is equal to 1. If we're doing semiannual, M is equal to 2. And in this illustration, M is equal to 4, and we could call that with quarterly compound frequency. So again, I'll use my calculator. I'll just replicate that so you can see it with the calculator. And again, working inside and out, I like to take my 0.8 interest rate, divide that by 4 is my number of periods per year, add 1. I'm going to hit equal there so that I've established the value inside the parentheses. I'm going to raise to power here, and then my exponent, I'm going to open parens so I can define my exponent as 4 times 2 or multiplied by 2, close parens. My exponent is 8 equals, that gives me my multiplier on the present value of, in this case, 10,000. And you can see I get the future value. Okay. Continuous compounding just extends the number of periods to its converging value. In other words, as M goes from 1 annual to 2 semiannual, I'll just draw that out. M equals 1 annual, M equals 2 semiannual, M equals 4 quarterly, M equals 250 or 252 would be daily, as in trading days per year. I keep increasing that M until I have an infinite number of compound periods per year. So that's as far as I can go as compounding it. And then we get that this very elegant form here for determining that future value. And again, I'll use the calculator here just to show you that. Right, so again, I like to start inside out, so I'm going to work on the exponent first. I say 0.08 is my R, multiplied by 2 is my N. So my exponent here is 0.16, and I just want to, it's e raised to that power, so I need to know my calculator well enough to know that I need to go secondary function here, hitting this key because that's my e to the x right there, and I've determined my multiplier, so I can multiply that by my present value of 10,000, and I get the future value. Okay, and now it becomes clear why it's very important to distinguish this fact that we have a stated rate here. Here my interest rate is 8%, and that is a stated or nominal rate. Stated or nominal rate is not the effective interest rate that we use because the stated or nominal rate does not include the compound frequency. So the effective interest rate that we would actually earn varies with the compound frequency. As we just saw, we can take the 8% stated or nominal rate. As we increase the compound frequency, the future value increases. So our effective interest rate increases as the compound frequency increases. So it's very important to keep in mind when we're merely dealing with the stated or nominal interest rate. And here we can convert that stated rate into the effective rate with this formula. 1 plus the periodic interest rate, that quantity raised to the m, subtracting 1. So that if I do that with the calculator, right, I'm starting inside out. My periodic interest rate is my 8% divided by 2 periods. So it's 4% per period. I add 1 to that, and I take that 1.04 and I raise it to the power of m, or the second power in this case, and then I subtract 1, and we can see that my 8%, if compounded semi-annually, translates into an effective annual rate of 8.16%. So for example, on $100, I would effectively be earning $8.16. And so this effective annual rate has a lot in common, is closely related to that APR, annual percentage rate, that is a required disclosure, for example, with credit cards. And so this would be the value we would really need to compare different interest rates with combinations of interest rate and compound frequency. And finally, we have the continuous version of that, which here is e raised to the stated rate, and we just subtract 1. So as usual with continuous compounding, this form is even more elegant. So now in this case, if I'm going to take my stated or nominal rate of 8% per annum with continuous compounding and convert it into an effective annual rate, I would take the 0.08 and I would make that the exponent in the e. So second e raised to that 8% gives me the 1.083, and I subtract the 1. And so 8.33% is my effective annual rate, which corresponds to the 8% per annum with continuous compounding. Okay, so that is the introduction there to all of these concepts under the interest rate. I'll look forward to seeing you on the next video, and if you like the video, please subscribe to the channel.